You've been told to follow the trend, read the candles and watch the indicators. Nobody told you, however, that all of this is just the aftermath of something that happened before your chart even updated. So if you feel like you're always late to the party, watch this series of lessons and learn how to stop reacting to the market and start reading it before it even moves. Welcome to Volume and Order Flow Trading, complete beginner's guide to reading the market. I'm Anastasia, I trade crypto and US futures, and this series is going to take you from the ground up, starting with how price actually forms, all the way through to real trading setups that you can apply immediately after watching. This first lesson is really foundational because if you skip it, the tools we cover in the next lessons will not make sense. So if you're ready, let's dive in. Every market in the world, stocks, crypto, futures, or forex, operates as a continuous auction. Buyers and sellers constantly compete to find a price they both agree on. When they agree, a trade happens, and when they don't, price doesn't move until they do. And that's it, that's a whole market. But to really understand this, you need to understand the two types of participants driving that auction at all times. Passive market participants are traders who enter using a limit order, also called a pending order. They do not chase the price, instead, they pick a specific price level and wait for the market to come to them. And it doesn't really matter who is this, a bank, a hedge fund, a pension fund, or a private trader like you or me sitting at home, because if you are using a limit order, you are a passive trader. So when price reaches your limit order, it gets filled and you enter the trade, but not before that. And now here is a crucial point. A passive seller needs an aggressive buyer to get filled. So in other words, sell limit order is always matched with a buy by market order. A passive buyer needs an aggressive seller to get filled, meaning that buy limit order is always matched with a sell by market order. Passive orders do not execute on their own. They sit and wait for someone to come and hit them, and that someone is aggressive market participant. An aggressive trader enters using a market order, as we already know, buy by market or sell by market depending on the situation, as they want in the market right now. They're not specifying the price and ready to take a trade at the first available price. So their order executes immediately against the first available limit order on the other side. The trade-off? They do not control the price. So if there aren't enough limit orders at the current level, they get filled worse than expected. That's called the slippage. And, well, we'll see exactly how it happens in just a moment. So we have passive participants and aggressive ones. But how do they actually interact? How does this create price movement? Let's look at this step by step through the lens of the depth of market. This is the depth of market. It's a tool available on most charting platforms that shows you all the active limit orders in the market in real time. The left side is a bid, passive buyers waiting for the price to come down to them, while the right side is the ask, passive sellers waiting for the price to come up to them. One critical thing to understand is that depth of market only shows you passive orders, which are the limit orders. So you will never see market orders here because market orders execute instantly and then disappear. So they leave no trace in the depth of market. So what this means is that the depth of market only shows you the intention of the market participants, but not the real action. The action is what we are going to have a look at next. Let me walk you through exactly how a market works using a very simplified depth of market example. We'll track just a few traders and see what actually happens. So Let's say market opens and there are no orders yet in the book. A few moments later, trader 1 comes in. He wants to buy 5 contracts, but he's not in a rush, so he places a buy limit at 98. He is our first passive market participant and his order appears on the bid side. Trader 2 wants to sell 10 contracts at 99, so he places a sell limit. And again, passive order. So his sell limit now appears on the ask side. And notice how we have both buyer and a seller, but nothing happens and the price doesn't move because the buyer wants 98 and the seller wants 99. So there is a gap between the price both of them are willing to trade at. And as there is no agreement, there is also no trade. More traders come in. Trader 3 places a buy limit at 97 and Trader 4 places a sell limit at 100. Then, later comes in Trader 5, who also wants to sell at 99. So now there are 14 sell contracts sitting at 99 on the ask side, since the new 4 contracts were also added to the previous 10, placed by trader number 2 first. Price, however, still doesn't move because the market is waiting for participants to reach an agreement. And then suddenly, something that all of us has been waiting for happens. An aggressive buyer finally comes in and he wants in right now. So he sends a buy-by market order for 5 contracts and his order hits the first available sell limit, which in this case is at 99. So he buys 5 contracts at 99, clearing 5 of the 14 sell limits sitting there, and the ask drops to 9 contracts. The last traded price, the market price, is now 99. So the price just moved because someone was willing to pay whatever it costs to get in immediately. Then an aggressive seller comes in. He sends a sell market order for 3 contracts, and his order hits the first available buy limit, which is at 98. So he sells 3 contracts at 98, clearing 3 of the 5 buy limits there. 2 buy limits remain at 98, and last traded price is now also at the same level. Now, here is a part that I really need you to lock in, because the price just moved down from 99 to 98, but it didn't move because there were more sellers. It's actually the very common misconception because traders often think that price moves because we have more sellers than buyers or more buyers than sellers. But in a matter of fact, at every single moment, the number of buy trades and sell trades is always exactly equal, because every transaction requires both buyer and a seller. So the price moved down because sellers were more aggressive than buyers, and that's the whole game of the market auction. Passive limit orders in this case act like walls. They stop price from moving through them by absorbing market aggression. So aggressive market orders, on the other hand, if, of course, there are enough of them, are the force that breaks through those walls. And therefore, this is what happens when there are not enough limit orders to absorb an aggressive order. Let's say, as we have an example, there are only 2 buy limits left at 98. And an aggressive seller comes in who wants to sell 3 contracts. So he clears both buy limits at 98, but he still has 1 contract left. There are no more buyers at 98, so the market has to move down to find the next available buyer. So the price moves to 97, where the remaining contract gets filled. So one seller now just moved the price a full point down, even though there were more buyers than sellers practically in the book. However, those were passive buyers and one aggressive seller who was willing to accept any available price. And now, a final situation that we're going to have a look at: what happens when there are no limit orders at the price level completely. When there are no limit orders at that specific level, like for example here at the price $98 per contract, We call it a gap. So what happens if an aggressive buyer sends a market order when the price is at 97? He expects to buy at 98, but there is nothing there. So the buyer in this case gets something what's called a slippage, which he gets filled at a worse price because there was no liquidity at the expected level, and the market literally skips over 98. This is exactly why trading liquid markets really matter, because for you as a trader, more liquidity means more limit orders at every price level, tighter spreads, and less slippage when you execute your order. Let's now lock in what we covered. First, the market is a continuous auction. Buyers and sellers constantly competing to agree on the price. Second, passive traders use limit orders. They wait for the price to come to them. Aggressive traders, on the other hand, use market orders. They execute immediately at whatever price is available first. The depth of market shows only passive orders. Market orders are not reflected in the depth of market at all. Price moves when aggressive orders absorb and break through the passive barriers. And the more buyers does not mean that the price will go up. In a matter of fact, it can be the opposite. It depends how aggressive buyers or sellers are. So in other words, passive orders stop the price while aggressive orders move the price. This is the foundation. So now you understand how the market auction actually works, how orders interact, how price forms, and why your chart is always showing you the aftermath only rather than the cause of the move. In the next lessons, we are going to build directly on this. We will cover the basics of the two main tools for reading liquidity and the market auction in real time: the volume profile and the footprint charts, and the trading methods for each that you will be able to apply immediately after watching this series. Subscribe so you don't miss them. Each lesson connects directly to the next one, so I will see you in the lesson number 2.